Hi, my name is Reed Silverne. The name of the show is Fed Pride. The reason it's called Fed Pride is because I'm a federal worker. I'm proud of it. I'm a federal worker, retired, rehired, and temporarily on board, and I'm very, very happy about that. First let me say, today for me, it's Friday, the 26th of September. I always say, you know, by the time you see this on Sunday the 28th or on Tuesday the 30th, everything I say will be obsolete. But this time, it really will be. Today I'm going to be talking about the financial bailout. I'm going to be talking about the possibility of world economic apocalypse or not. And I'm going to be talking about the debate. And of course, I am here before the debate. So not only am I talking today to people who are going to be watching on Sunday or Tuesday about the situation at this moment, but not only will the situation have either been resolved or not, but on top of that, the debates will have happened, which is probably a lot more important than what I'm going to be talking about today. Will you still watch? I don't know. Maybe you might want to see what Reed Silverne or Fed Pride was thinking about on Friday. So what's happened? Last week I talked about global financial apocalypse. Is that a little bit dire? Yeah, a little bit. Is it a possibility? The fact of the matter is yes. A lot of people are rejecting in their minds, opposing in their minds the bailout of Wall Street and the derivatives that started this mess that I've been talking about for about a year and a half on this show. And I can understand it. I think that a lot of the people that caused this mess, the executives who put these derivatives together, the derivatives that were based on not just subprime mortgages, but on mortgages in general and on credit in general, were frauds. They were, I believe they understood that they were selling things that had no value. And as a result, I think that they were openly, intentionally committing fraud of a massive amount. And now we're talking about taking the results of this fraud and having the taxpayer buy it and bail it out. Why would anybody support that? It's considering that the people who are behind it are thieves of the highest possible historical order. You go back in history and you look at Fisk and Gould, the people that cheated with the New York Railroad and Vanderbilt and the robber barons, and what has been done in the last 5 years has put that to shame. This is the largest, absolutely critical, superhuman historical fraud in the history of the world. Can it be reversed? Well, no, it can't be reversed, but we can prevent going into financial panic over it. Do I feel that the people who issued these derivatives, people from USB, from Barclays, people from some of the largest hedge funds, people who packaged them and sold them through mutual funds, some of the banks that bought these and ended up destroying the nation's credit as a result. Do I think they should go to jail? I think they should go to jail. And I'm not mincing any words about it. And I'm not saying words that I haven't said before. I think anybody involved in marketing or initiating or packaging mortgage-based derivatives that ended up becoming worthless should be indicted and charged with fraud. I am not mincing any words about that. I believe that they understood that these things could not possibly maintain the value to the people and the institutions that were buying it. Why do I think that? Because what they did was they bought a pool of mortgages and then they put together these derivatives, but the cash flow, the owner of the derivatives, the person who bought the derivatives, only had the equivalent of a bond. The principal, if the principal was preserved over the period, and then a certain percent interest rate split by tranches. However, they did not and were not given an interest in the underlying assets, an interest in the underlying mortgages. Even today, with the foreclosure rate historically very high, but no higher than during the early 90s S&L collapse. So it's not an ahistorical. And we have survived default rates. Default rate, what? 6-7% at the most. More like 4 or 5% in most places. What does that mean? That means that the property behind them and the mortgage backing the property behind them are not completely worthless, because they can be resold when the market comes back. And the market is slowly but surely coming back. So basically we have 94% of all the mortgages at full par value, and the other 6% with some recoverable value. So that's about 97%. So why were they worthless? They were worthless because they were not selling the underlying asset with the derivative. The rating companies should have realized that. In fact, they were told that. The basis for the cash flow was not the payments on the mortgages, but it was a series of swaps based on default rates. So when the default rate got a little bit worse, when it doubled, basically the value of the derivative bottomed out. So instead of saying, look, the people who are bought these mortgages are paying 6%, we will use that 6% to pay the interest on these derivatives. They're not linked at all. So the whole thing from the word go was a fraud, was a criminal fraud. Anybody who analyzed them, anybody who read the fine print, anybody who realized how they were structured would know that they were ultimately going to be worthless if there was even the minorest slowdown in either the asset value in generally in the housing market, or even a tiny slowdown in the economy that would cause a slight increase in the default rate. Actually, doubling the default rate at the time, which was about, I think it was like 0.8%. So if it went to 3%, these things already became worthless at the bottom tranche. So what was the result? The result that they were sold to institutions, they were sold to investment banks, they were sold to pension funds, they were sold to hedge funds, but worst of all, they were sold to banks. And as a result, the banks got these derivatives without any underlying value. There is an accounting rule that's relatively new. It's called FASB 106. What FASB 106 says, if you have an asset, you have to value it at what it is really worth. And as a result, the market collapsed on these things when the default rates went up. Nobody in his right mind would buy them, because now it was obvious that the thing was a fraud from the word go. By the way, only, as far as I know, only one issuer of these subprime mortgage derivatives has ever been indicted, and he was not indicted for selling worthless derivatives in the first place. He was indicted only when everybody had to admit that these things had become worthless. He told people he was marketing it to that they were not yet worthless, that they still had value. So nobody is right now on the road to be indicted for issuing these turkeys in the first place. And that is outrightly wrong. Just because they had deregulated reporting on these kind of vehicles, and they allowed the marketing on these kind of vehicles so long as they went through electronic trading of one kind or another. However, that doesn't mean that they legalized marketing instruments, debt instruments, CDOs, whatever you want to call them, derivatives, that were by definition going to be worthless. Obviously going to be worthless. Why is it obvious? Because a slight perturbation in a default rates to a rate that had been historically experienced within the last 10 years would render them worthless. So it should have been obvious that if they were going to rate these things at all, they should have been rated DD minus or F, and not AA or AAA. Even presenting these to a rating service as not being worthless, as not having a 90% risk of loss, was a fraud. These people should be indicted, and they should review the real laws about fraud and what the definition of fraud is, and take a look at the traffic. You'll see that the issuers and the creators of these things basically based all the value on certain calculations that had never been tested or proved, and they admitted it. So who is crazy enough to issue these things without having some thought that maybe he is creating a fraud? So I believe, and I sincerely believe, that from the word go, the creation of these financial instruments, these subprime mortgage CDOs, were a fraud. But does that mean we shouldn't bail it out? No, it doesn't. First of all, what happened was all these banks bought these instruments and now have them in their portfolio. When they went sour, they had to show them at a loss. And we have a rule that says banks have to have approximately, it's a little more complex than that because there's different levels of capital, but they have to have 5% capital for what they loan. So every dollar that they lose the ability to give out approximately $20 worth of loans. And what's happening now after AIG fell, after Freddie Mac and Fannie Mae were taken over by the government, AIG taken over by the government, Lehman Brothers, one of the biggest issuers of these things, collapsed. Both Goldman Sachs and Merrill Lynch, Merrill Lynch being sold to Bank of America, and now WAMU, which is I think the 5th or 6th largest thrift in the entire country, depositor thrift, just collapsed and was seized, but immediately resold without any shareholder equity to J.P. Morgan. So basically everybody's going to keep their deposits without having the FDIC actually bail them out. So basically there is a tendency in the entire financial system to burst at the seams because nobody really has the trust to be able to loan anything to anybody else, as long as these derivatives stay on the books of these institutions. These are not just American institutions either. Almost all the major banks of Europe, some of the major banks of Europe like USB, which is Swiss, Deutsche Bank, and Barclays in London, actually were selling these turkeys. They were putting them together and selling them too. And instead of Moody's, which is an American rating firm, they were going to Fitch, which was also giving them AAAs. So there is a very, very great problem over here. It is exactly the same problem, and I've described it before, that we had during the Great Depression. I've done a couple shows on this. When they reliquefied the world economy a few months ago, when they did Bear Stearns. I mean, we've been basically on a roller coaster between one failure and the next, trying to prevent the one extreme failure that's going to cause bank after bank, institution after institution, pension fund after pension fund from collapsing en masse. And that did happen. When did it happen? And I'll be honest with you, it didn't happen in October 1929, which was the stock collapse of the Great Depression. It happened the following year. The Bank of the United States basically There was a run on the bank. There was a rumor that they had no cash left. The clearinghouse refused to give them credit, basically made them illiquid. They did collapse a couple days later, and they caused a bank in the largest bank in Austria to collapse, the largest bank in France to collapse, and the largest bank in Germany. Germany was already in trouble, collapsed. And basically there was a seizure of the capital markets to the point where nobody could borrow money at all. Consequently, business after business went out of business. They only could deal in cash. The cost of commodities actually went down, and that deflation has already started. That is the houses in this country losing value. It was offset by an increase in the values of commodities, which kind of indicated an inflation going on. However, that has turned around as well, and commodities have stabilized, although some of the same jerks that put out the mortgage securities also have what they call CCOs, which are commodities securities. They're based on the same thing. They're based on a series of swaps. And because they had to have a constantly increasing value of commodities to back them up, they pushed up on purpose, wash traded, got around regulations because regulations had been lifted. Now regulations are back in effect, and at least the CFTC, the Commodities Future Trading Commission, are able to at least catch the people manipulating this. And there was a recent $16 in one day increase in the price of oil. And I wouldn't be surprised if it wasn't caused by the same crooked Swiss company called Vitol that did the $11 increase on June 6th and was caught because the CFTC was watching. What's happening on the rest of the market? The rest of the market is still deregulated. Part of this package has to be that we are going to re-empower the SEC. McCain is right. We need to fire the head of the SEC. He did nothing. He didn't even try to oversee the banks and so on and so forth. We need to get rid of all exceptions for hedge funds. We need to consider all banks as commercial banks with requirements for capital. And we need to put a rule in place. Now, FASB 106 is strong enough, but we need a rule in place that says that when a new financial instrument, a new derivative, or a new idea in finance comes out, that the value has to be proven before they are able to be issued. How do you prove that? You have to have a small, do it the way we do with drugs, a small issuance to see how they react to differing market conditions and to see whether these things have real value or no value. We cannot allow, and they will do it immediately, the second that things stabilize. The CBOT, the ICE, which is the Intercontinental Exchange, which is actually in Atlanta, but claims to be under English law. A lot of these exchanges are going to go back to what they've been doing, which is creating new, weird, unexplainable, inexplicable financial instruments and then sell them to the market after conning rating companies into giving them good ratings. So basically, the assumption should be that any, and I mean any, new financial instrument that's not routine bonds, stocks, any derivative has to, or index funds has to actually link the ownership of that fund to actual assets, not to change value with the asset. They have to be linked to the assets. Whoever is issuing an index fund has to buy the asset, and if that asset is not available, he cannot do an index fund. So if somebody wants to have an index fund of a collection of stocks, all the financial stocks, for example, he has to buy a pool of real financial stocks. Whoever buys his fund has to own those, has to own a share of those actual stocks and bonds. So basically, if they're going to be linked, they're linked to commodities, or if they're linked to debt obligations, or if they're linked to mortgages. Basically, if they sell a new market derivative, that derivative has got to actually, the person who buys a derivative has to be buying a share of the underlying assets. Anything else is fraud. Any rating agency, any government agency that sees that these things are delinked has got to say, these are completely worthless. We will not allow these on the market, and we will charge you with fraud if you even bring them to a rating agency without proving an absolute unbreakable link between the value of what these people are buying and what they have bought. And basically what happened was we let these frauds, these criminals, create $700 billion of money, and now that money has disappeared. And the result is we are standing at the precipice, at the edge of a Great Depression if a bailout does not occur. If the banks don't get these off their books, either by selling them to the government or some other means, and I'm not saying insurance, then there will be a depression. It's already started. The depression process of a freezing of liquidity and failures of banks leading to other failures, leading to other failures, leading to other failures. Apparently, WAMU, Washington Mutual, did hold some Lehman Brothers securities. Even our own county, Pima County, has some. The decision to let one of them go and see what happens almost threw us over the edge. And this bailout is the temporary or possibly permanent solution. We need to bring normality back to the markets, and we need to do that not because of Wall Street fat cats. They need to be jailed after a trial because they've defrauded tremendous amounts of money and caused unbelievable amounts of pain. But even as they're going to jail, we need to bail out their institutions so that they can start loaning money to companies to keep the jobs that have already been created going. Basically, we have 116 million private sector jobs in this country, and almost all of them, or a large portion of them, are dependent in one way or another on credit being available. What does credit mean? Credit is the Latin word for he believes. Basically, you put $1 into your bank account is credited $1. It means that you believe, you are he, that there is $1 worth of value in that account. The minute you don't believe it, it is not there. It does not exist. And 99.999% of the wealth in this country is based on belief and confidence that these pieces of paper, these rags, have value in it. And these pieces of paper reflect the value of your house, the value of your land, the value of your job, the value of the company you work for, the value of your pension fund, the value of your 401k, and everything else. The minute either you stop believing that these have value, or the banks stop believing that they have value, and that's what's occurring because banks are refusing to loan money to each other to support car loans, student loans, business loans, and everything else, inventory loans. We have a big problem, not just in this country, but in this world. We've already had a stock collapse in the Middle East, which depends on Dubai. We've already had a stock collapse in Moscow, which is partially also caused by the Georgia situation. But this thing is already ongoing. We need to stop it with the bailout. My name's Reed Silverin. The name of the show is Fed Pride. The reason it's called Fed Pride is because I'm a federal worker and proud of it. Thanks for watching.